With that, let's go ahead and begin. Thank you all for joining Bryan Knutson and myself this afternoon. We're here to provide Cutler's third quarter market commentary as well as our market outlook for the fourth quarter. I'm Erich Patten. I'm Cutler's Chief Investment Officer. Bryan is a senior advisor here with Cutler, and we're going to be walking through a presentation here. Let me pull it up for everybody. All right, here we go. We begin every presentation the way we always do with disclosures. I think the important thing in these disclosures are that these views today represent October 19th. Should new information come to light, which it always does, we will adjust our views accordingly. So this is as of today, and please talk with your advisor before making any investment decisions based on anything we're discussing today. But let's go ahead and jump into it. Here's an executive summary of today's presentation. So I just want to talk about each of these briefly before we jump into them in greater detail. The first one, growth continues, but has trended lower in the near term. We really saw a deceleration of growth over the summer, and Bryan and I will get into that. Inflation remains elevated. Will it become transitory? Inflation is the hot button issue of the day. It's really the buzzword that everybody's talking about. We're going to dig into that and talk about what's causing inflation and maybe discuss whether it's transitory or more permanent. Consumer confidence and activity is key to growth potential. We have a consumer-based economy, and for us to continue to grow, consumers need to be able to spend money. So we're going to talk about that. Although stocks are trading a bit rich, they remain a resource to try outpacing inflation. We call that TINA here at Cutler. There is no alternative. We've seen people buying stocks really hand over fist, given the other options out there for income, for investment returns. We'll talk about some of those asset classes today. And then finally, bond rates remain low and selling pressure could increase. We'll talk about what's going on with bonds, maybe some opportunities in the bond space and what to look for there. So what happened in the third quarter? I think you can summarize a lot of what happened with this chart. Bryan, you want to walk us through the coronavirus chart here?
Sure. Hi, everybody. So what we had here is, this is a chart going back to the beginning of tracking of corona-related cases. We had a peak, back in late 2020. Then we had the introduction of the various vaccine treatments. We had a reduction. We got to about June or July. We all sort of started looking around and said, are we in the clear? And then our new favorite word, Delta, came up and said, nope, not the clear just yet. We started to see an increase in those cases. That went into late July, August, into September. We're going to see on some future slides exactly what that did to economic growth. Here's a foreshadowing.
All right.
And so what do we know? Will, all the better for the future, and hopefully we've gone through this this next phase and we can go on with life.
All right, so what are we looking at this on this next chart here?
Oh, sorry. So my screen just went a little blank, but I can tell you, sorry, that what we have here, there it is a chart that we've looked at before that I really like about some different aspects of economic activity. There are 6 lines on here. In particular, I'm going to highlight 3, and we're going to look at that area that's in the red circle. The 3 that I'm going to key on are the kind of greenish, that's hotel occupancy, the darker purple, that's sit-down dinners, and the light blue, that is air travel, air traffic. So what we have here is we have some comparisons of a baseline back in February 2020. We had massive drops, especially in like seated diners. For example, no matter where you live, who you are, you could not go out to dinner for a while there. It went to -100. Whatever normal was before, however many millions, it went to 0. What do we see? Rally back up. And then eventually where you see that dotted line right underneath the box, that is when we're no longer comparing to 2020 because like say, hey, look, there's more box office at the movies. Well, yeah, because last year there was none. So now at that point, what we're comparing to is 2019. So instead of shooting those fish in a barrel, you have to actually try. What do we see? Some significant continuous increases in activity until foreshadowing or going back, excuse me, no more foreshadowing, backshadowing to the increase in Delta cases. We saw a decrease in those areas. Those three that depend on people to be willing and able to go out and do those things, go to hotels, eat dinner, out, and air travel.
So I think, Bryan, I'm not sure if you can hear me. You're freezing up a little bit. So I will take the baton and run with it.
Since then, they've gotten even better. They're about 5% below.
Bryan, I want to interrupt for a second. I think you're cutting in and out a little bit, or either you or myself are. I apologize.
Okay,
but I'll take the baton and run with it as we go to this next slide here. What we wanted to point out is consumers on the previous slide, consumer spending is down, and there's a lot of different reasons for that, but the biggest is Delta, right? And we saw that decline in restaurants, especially in travel, because of Delta. But consumers have a lot of cash. We have more cash in consumers' pockets than we've ever had, and the chart on the top left here shows that. You can see the spike. A lot of that was government support. We had an incredible amount of stimulus last year. A lot of that has been people don't have as much money to spend. So, or sorry, as many people have not been spending as much money because they haven't been going out, they haven't been buying things. So people have accumulated a lot of cash. We also, at the same time, have a demand or a supply problem. You can see this picture of this ship here. The anchored ships in Long Beach are hitting all-time highs. We can't unload those ships fast enough. We have a big problem with the logistics and the supply chain. You can think of truck drivers. We're having a hard time finding truck drivers to unload those containers onto. So it's not just a bottleneck at the ports, it's a bottleneck throughout our economy. So we have a disconnect, and I'm going to draw a quick picture here that'll show us, this is kind of harkening back to Econ 101. But we have price on this axis, quantity down here, you have supply, and you have demand. So supply and demand. And what's going on right now? Well, supply, we used to have a clearing price right here. Supply has moved up. So now the price is here. And this difference is inflation. Bryan, let's talk a little bit about inflation. And we're having it, we know that. Walk us through the CPI, please.
Sure. Okay. So hopefully everybody can hear me clearly again.
Sorry, yeah, I can hear you I can hear you just fine now. There was a couple of hiccups, but.
Okay. Sorry about that. Okay, so this is a chart going back to the 1970s about CPI, Consumer Price Index, changes over time. What we have noticed over time is that we had a period that I was a little young then, despite this, but I've heard of all the spikes in the 70s. We were seeing numbers in the 10s, 12s, 14s, and then after that, then we kind of burst the bubble, that whole situation back then, and then we got to a period where inflation has been running, and you can see that line there, the gray and the blue, in the 2s and the 3s. Then we got to the point later on with some reductions in price for certain things, like keep this in mind, a TV costs less now than it has in years past. A computer costs less now, or can at least, than it has in years past. You've had some decline in prices. You've had some reduction in oil costs and gas costs until the most recently. So we were seeing some very moderate type numbers. Then what have we seen very recently? A pretty noticeable spike up. It's noticeable compared to where it has been, not compared to where it was, a generation and a half ago. We're not saying that, but it is a noticeable increase, in particular because of one or two particular aspects. If I look into the box, I can see headline and core. What's the difference between them? Just a high level is one of them does not include food and energy. That would be core. The other one does. Okay, so what do I notice? Over time, they don't track exactly, but they tend to follow each other. One might move up, the other one moves up after, one moves down, the other tends to move down after. Not always in lockstep, but similar. We're seeing some decoupling now. Again, it's kind of hard to see because we're looking at that very right-hand side of the chart. But what is the biggest differential right now? If you look into the guts of that box, energy CPI, the cost of gas, natural gas, things like that, is climbing rapidly. It's the only real outlier number on here, and that is driving a lot of the decoupling between headline and core, right? They tend to be much closer together to each other over long periods of time than they are right now. And so if that changes, then we could see some of that mitigation that we're looking for in those numbers. If it doesn't, then maybe we won't for a while.
Yeah, it's pretty remarkable that energy prices are up 25% in the last year. I don't think it's a big surprise, given that the best performing S&P sector this year is also energy. So we're seeing huge increases in the energy demand out there. Bryan, this shows that we've had inflation on the rise. You think it's not done? You think we could continue to see inflation move higher? Let's see on this next chart a couple of reasons why.
Okay, so let's get into the guts of it a little bit. Let's lift the hood on how do we calculate CPI. The biggest factor in the consumer price index change is, if I look at that pie chart on the left, one of those pies is by far the biggest slice, right? I'd love it if it, a nice good pie there. It's 42%, that's housing. And housing in this case is not home prices, it's rental prices. And it's actually a little even more wonky than that. It's an assumption of what homeowners think they could rent their house for. So, you got to kind of, follow that logic and realize that hasn't moved very much. I'm going to explain that it is on the right. But first, let's look and say that's almost half of this indicator. It has been very steady, while other pieces like food, which we see is also pretty big, and transportation, which would incorporate gasoline, gas prices, is also pretty big. Those have been moving up, and housing has not yet. But if and when that does, that can have a significant impact. If you add those three aspects together, they collectively make up 3/4 of this indicator. So they are the drivers. Other ones certainly have an impact, medical, et cetera, but not nearly to the same degree. Okay, so what have we seen about housing prices? Let's look over on the right. This is 2019, 20, and 21 to date through the end of July. So it's a couple months old, but it gives us an indicator. Last year, what do we see? Rent moratoriums, rent freezes. That didn't necessarily mean people that weren't paying their rent. I'm not, it's not all that. It is some people that didn't get a rent increase because, landlords had to be flexible and had to be accommodative. You did see actually some decreases in effective rent. Some of that really is from, a deferment, I'll call it a payment, or whatever the specific situation was. However, what tends to happen, right? If prices start to come down and we're looking for some equilibrium, we start to see some rise. Look at these numbers in the pink on the right, and keep in mind, these aren't annual changes, these are monthly changes. Monthly changes, about 1/4%, about 3/4%. Okay, we can absorb that. Then we get to 1.5, we get to 2, we get to over 2. This is starting to have a distinct impact because keep in mind, as we saw on the left, not only does this impact CPI potentially, it has over 40% of effect. So what we're hoping is some other prices will start to come down, and some of them definitely should, and I believe will. What we need to see is how does that correspond with the changes we could see on the rent side. This is something to certainly watch out for.
Yeah, to put some hard numbers on it, that 42% that you see on the left side of your screen, that was up about 2.6% through August. Housing prices were up 20%. So there's a big disconnect right now between what the CPI is showing for housing and what housing is actually doing. I think most of us, regardless of where you're calling in from, have experienced pretty rapid housing price increases, largely fueled by that low interest rate environment that we found ourselves in. And that's changing. We're beginning to see very slowly pressure on the Fed to raise rates. And they've been very conservative, very dovish ever since the coronavirus shutdown happened. And the Fed has been very slow to move off of the zero interest rate environment that we found ourselves in. But there's hints, not hints, very strong language that they're likely to begin curtailing or tapering their bond purchases by $15 billion a month starting next month. So the Fed is going to stop being an active buyer of bonds in the market. That should lift bond yields a little bit. And then this chart that we're looking at really shows the market reaction, what the market thinks is going to happen with interest rates. And there's been a lot of movement since the last reading of inflation just a week ago. So inflation came out at 5.2%. The expectation was 5.4. The expectation was at 5.2. And you can see that jump from the dark green line to the black line just in the last week. The light green line is where we were a month ago. So what this chart is saying is the market thinks we could have 2, maybe 3 interest rate increases next year. That's going to be great for your savings account. Your cash finally will start to have a little bit of yield. Your money market funds out there right now are yielding close to 0%. If you do have cash on the sidelines, you're looking for ways to get a little bit more interest, talk to your advisor at Cutler. We do have some ideas on cash equivalents that can help you manage your cash. But the environment we find ourselves right now is a lot different than where we're going to be a year from now as the Fed begins to raise rates. So things are going to look different. This is going to put some pressure on bond yields as well as we move into especially the second half of 2022. All right, so last quarter we had a consumer lull and then a slowdown really in GDP. Brian, what are these two charts showing us?
Sure. Okay, so the chart on the left is a construct of a balance sheet. Maybe think of it an idea of where. Oh, sorry, this is more of an income statement, not a balance sheet. Sorry, excuse me. This is a composition of where we drive our GDP. It's a $23 trillion economy. So let that number kind of percolate in your head, and you think, my gosh, that's by far the biggest in the world. It's not even close. Out of that, 70%, 69 exact, well, let's call it 70, is us going and going to the movies and buying things and legal services and other services. That is $16 trillion worth of activity. So even with some sizable increase in government spending and some other things like housing, which is us doing home improvements and things like maintenance, that isn't us buying houses, and that's not the value of our house. That's activity related to it. But basically at the core of it is us. We need to be able to drive activity. Last year and into much of this year, when we couldn't or wouldn't, we had to have some other pieces step in and kind of bridge that gap. Remember, we used that term in previous webinars. Now it's going to be about that time. We got to go grab that baton and start going. Are we doing that? Well, let's take a look at the right. There are 2 lines on here. One is the blue line, and one the green one. I'm going to focus on the green real-time estimate from the Atlanta Fed about where they estimate the current quarter, the most recent quarter's GDP number to be. We can see that it was in the 6s. Now, it started in late July with an estimate of just over 6. Maintain, like 6, good. We're coming off of very low numbers last year, so having some outsized numbers this year isn't surprising. Then we got into the Delta case, we got into some slowdowns, we got into some increased restrictions, and started to see those supply chain issues that started to come down. Okay, starts to get into the 5s, get into the 4s, get into the 3s. All right, we can still, that's still a good number. We can still, make that work and keep going. Then we saw that, this wasn't just maybe we're not going to go to the movies this week. This became, we can't get the supplies we need on time from fill in the blank, country of origin or whatever it might be. We saw some more noticeable drops. It got down to the point now where the estimate is about 1.3. The big question on this one is that 1.3, is that the new normal? No, we don't believe so. Is this just kind of stretching out the growth that we would have had otherwise, right? That doesn't mean people don't want a car. It means they couldn't get it right now. When can they get it later? That's what we really need to find out, is how long does it, does this, we'd like to put a number on it. what we thought was a 6, if that comes as a 1, if we thought next quarter would be a 2, does it really become a 7? We have to find out. We really don't know that answer just yet, how long it might take. One other key point on here, the blue line that I referred to before, that is the call it the Wall Street economists' estimate of where they think GDP is going to be. The first thing we usually notice is they come in higher, right? Even from the beginning, they were above the Atlanta GDP estimate from the very beginning. That is not unusual. They tend to be more on the high side. The Fed tends to be more on the low side. Hopefully we can meet in the middle. What do we notice though? They dropped just like Atlanta GDP dropped until they got to an inflection point in about the second week of September and went, wait, no, we actually think things are going to get better. I'd love them to be right. I don't really think they are in this case. I think maybe what they're doing is accelerating some of that future growth. But that kind of that crocodile jaw there of this going down and this going up is interesting because they really are separate in their estimates. Who's going to be right? Time will tell.
Well, if history is any guide, the number will come up somewhere in between. But I think the optimistic case, the bull case here for the economy is that consumers are 70% of our economy, and they have a lot of money right now. So, if we can get the goods for people to buy, we should see that economic growth. Today, Airbnb's CEO came out to say he thinks we're going to see a influx of travel at the end of the year as consumers, one, get more comfortable with the state of the virus, and two, have a lot of accumulated PTO because they haven't been able to use it as much in the last year. So there's a lot of anecdotal evidence that we could see this recelerate heading into the fourth quarter.
And I'll be on a plane to Arizona tomorrow doing my part. So I'm out there trying to help all of us. You're welcome.
All right. Well, there's also, this is a really interesting time to be a labor economist. There's also a really dynamic jobs environment right now. And this is related to the economy. The unemployed rate is not that high right now. In fact, we have more job openings than we do unemployed people in the United States at the moment. Bryan, explain that to me and talk us through how that could be the case.
Sure. Okay. So let's look at the chart on the left-hand side, the one in the middle, really. This is the number of unemployed people versus the number of collective job openings. Generally, there are more unemployed than job openings for most of these years because kind of the classic idea of economics, like going back to Erich's good explanation of Ecce 101, here's another one. You're going to tend to have a number of people that are unemployable. They consider themselves participants in the workforce, but employers don't consider them attractive members of the workforce. So you tend to have a baseline of unemployment that historically, a number that I remember seeing was 5. Then that number became more like a 4. Then we got to an unemployment number in 2019 or so that was like 3.6. Okay, great. You had more part-time work, you had more specialized work. Great. Okay, but what did we see last year? We know that there was a massive spike in temporary, and it turned out to very much be temporary, unemployment when certain places just could not do business. Massive spike up and then a big drop back down. The big conjecture now is about how long it will take for that to continue to go back down. But in the meanwhile, what is happening? You're getting, as we see on the title of this, the Great Resignation, you're getting millions, and I think literally the number is over 4 million people resigning from a job they already have in hopes of migrating over to something else. They are, maybe not moving up so much, but is moving to a situation that's closer to home or that they like the schedule, whatever it might be. So that's leading to job openings to replace the people that already left. You're also getting a situation where employers tend to be thinking about the next 100 people they need, even if they might only be able to fill 50 or 60 of those. So there are, I believe at this point, the number is about 1.5 million more job openings listed than job seekers. And that, you can't do it. I mean, unless people are going to take multiple jobs, and you certainly can, then, that disparity could continue. But I think some of that is just the phenomenon of employers looking at this, going forward with this growth trajectory they hope to be on and they expect to be on, and saying, we need to really stack up. And then, people out there being a bit more selective than they've been in the past, because, with this many job openings, you can feel pretty solid about that, of saying, well, I don't have one opportunity I need to get. I have 5 or 6 that I can choose from. And if you go over to the right-hand side, What we have here is the lowest unemployment states by percentage and the highest. The national average right now, excuse me, is about 5%, give or take. But of course, we know that doesn't mean all 50 states plus DC are at 5%. If you look at the high end of that graph, the biggest thing that jumps out to me there, first, you'd love to see the low numbers, but also those aren't that big of states. I think the biggest one on that by population is either Oklahoma or Alabama. I don't know, it's one of those two. And that's great for those states. That means that, their participant workforce has been able to get back to work, and they do things that are active right now. If you look down at the bottom, the biggest thing, two things jump out to me here. First, we'd love to see those numbers go from the 7s down into hopefully the 4s, but at least the 5s. But also look at the size of some of those states. Illinois, New Jersey, New York, and California in particular are, I believe, all 10 million or above, and at least 2 of those are 20 million or above. So that's a lot of people. So you have a big state full of a lot of people with a high number that is keeping those aggregate numbers up. And there are many different factors there. Every situation is different. But to get the number collectively down, we need to see bigger states get smaller numbers.
Yeah, the one thing that this disparity is doing, though, is creating wage inflation. And wage inflation is different than some of these supply chain numbers that we've seen, because it's stickier. You don't generally hire someone at $20 an hour and then lower them to $19 an hour a few weeks later. So, I think this is inflationary. This is part of that inflation story, and it's another reason why we have been biased toward equities, which have some of those inflation protection or that growth capital that can maybe weather some inflation a little bit better. So let's jump into talking about stocks, talking about various asset classes. We're going to talk about the stock market and then the bond market shortly thereafter. But here's the stock market, the S&P 500 for the last 25 years. Today, we're not at an all-time high, but the market went about sideways for the last 3 months. The third quarter numbers were effectively flat. And as advisors, we think that's great. And the reason is we have elevated valuations. Stocks are expensive, and sideways means stocks are getting a little bit cheaper as companies grow into that valuation, especially given that drop we saw in GDP in the third quarter. Having a sideways market is great. We've recovered a little bit in the last week. Stocks have actually been doing great for 7 days or so. But I want to point out on the far right-hand side of this chart where we sit today, stocks are trading at 20.3 times earnings. 3 months ago, that same number was 21.5. So by going sideways, by consolidating a little bit, we've lowered our valuation in the stock market, and hopefully companies will continue to grow, bringing that number down even further. But it has been elevated for quite some time, and the reason for that is with bond yields so low, there's been a premium on stock prices that's been sustainable. We've had a elevated valuation really for almost a year, and so that that's something that investors might have to get used to as we continue to grow into that current valuation. Stocks have hit a lot of new highs this year. Bryan, let's walk through this chart on the left here.
Let's do it. Okay, so the chart on the left is giving me an indication of the number of calendar trading days in a given calendar year that the S&P 500 index has hit a new high. It doesn't matter if it's up 1% from the previous high or 0.01% above the previous high. It's just a number of new highs. And what I tend to find here is they come in batches. Excuse me. There are multiple years in many cases where they don't. That's coming out of some market sell-offs or times where we're just sort of flat, like Erich noted we were in the third quarter.
It is a lot easier to hit a new high if you just hit one, right?
Exactly. Yeah. So something you just climb right up. Like for example, today we closed less than 1% below the all-time high. Okay, so if we had one more day like this, oh, there we are, we're back again. It could be that easy, or it could be very hard because the last time we hit a high was September 2nd, which was 7 weeks ago. So if I look here though, I can see a few years really jump out. I won't go over every single one of them, but in particular, we had a significant number of new highs back in 1987. Wall Street, Gordon Gekko, greed is good, all that stuff. Then we had another spike in the number of highs in the late 90s. That was when blobbydyblah.com went public, and it probably did. I don't remember it, but I'm sure somebody here owned it. Then you had a market sell-off that lasted multiple years. That took a while to dig itself out of. Then you had another market sell-off. It took a while to dig out of that one. Then we got our footing back again in the 2013 plus range, and we're getting some more highs, 20, 30 of them a year. And remember, that's like 1 out of every 10 or 12 trading days. That's a lot. Then we get to this year, 53. We've had 53 new market highs this year, and it's only October 19th. We still have over 2 more months for the potential that you could have more. 53 of them out of about 200 trading days. So 1 out of every, give or take, 4 days of trading. I think it's even a little bit less. We've hit a new high, right? Back in January, February, March, you just wake up in the morning, look, and go, oh, there you go, another one. So this can lead to high prices. It can also lead to some complacency. And what it can really do is make it seem surprising when you see a sell-off again, because if you don't see one for a while, you forget perhaps that they exist. Let's look over at the right-hand side. Not only do sell-offs exist, they happen every single year, right? Even in 2017, which if memory serves, I think was the first year in history, in modern market history, that we had no negative months. Think about that, 12 months of positive returns. Even that year, you got sell-offs that were worthy of noting here, because they can happen. If you have 3 bad days in a row, that's your sell-off for the year, perhaps, or more. What are we seeing this year? Here it shows a -5. We're going to show you on an ensuing slide that it got maybe to -6. That is normal. That's actually light, right? Look at this. 5 6s, 5 6s. I see quite a lot of them throughout history, and then they're sprinkled in with the 17s and the 18s. Keep in mind that a bear market, officially a bear market, is 20% from the high. It doesn't mean 20% from a high that makes sense. It doesn't mean from the high at the start of the year. It just means from a high, right? We got to 4,565 last year. Sorry, I'm getting really wonky. I won't get into numbers, but it got into a really specific number that is really high, right? And so if you get drops from that, okay. And what you also tend to notice these days is that I'm just get on a little soapbox. Numbers get bigger, so it looks like drops are bigger. Percentages don't change, right? A 0.5% drop today is the same as a 0.5% drop 20 years ago. It's just a different number, right? So if you look here, most years we end positive. Most years we have a significant drop. Most years, people need to remember, they've had these before, we're going to have them again. Could we have another one? We really could. And the biggest reason why is, even though last March seems like that specter right on our shoulder, that was 20 months ago, right? We tend to find corrections. And remember, a correction is only a 10% drop, but a 10% drop from the high. We haven't had that. We haven't had one since last March. And,
yeah, but we have had a lot of movement in the market. Let me talk about this slide a little bit, because we have right now a S&P 500 that's very much dominated by few companies. Think of those big tech names, a lot of them on the left side of this page, and we just showed that the S&P was 6% at the lowest from its all-time high. We had a pullback of 6%, but look at the amount of dispersion that took place underneath that 6%. So you have some stocks, and I would call these all kind of the pandemic stocks. Think of Roku, Peloton, Zoom, which we're all using today. Those are down over 50, 40, 50, 60% off of their highs. Zillow down almost 60%, which is amazing to think. Zillow, with housing prices up over 20% year over year, Zillow stock is down significantly. So there are pockets of opportunities, and definitely if you look kind of under the hood of the S&P 500, you can find those pockets of opportunities. Look at the right side of this slide. And here we have, in the olive green color, the top 10 stocks. You can see those top 10 are trading at 28 times earnings. On average, the top 10 stocks trade at 19 times earnings. But what about the other 495? Yeah, there's actually 505 companies in the S&P 500. So what about the other 495? Well, they're at a much more reasonable 19 times earnings, right? So we don't have an S&P 500 that is just one thing right now. We have some very big, very dominant companies. Think of Apple and Microsoft they're $2 trillion companies now. To be included in the S&P, you don't have to be a fraction of that. There's numerous companies in S&P that are 20 billion, 30 billion, 40 billion. It's a large company in the US is in that realm of that kind of $50 billion range. So you don't have to have a portfolio or investments that are dominated by those big companies to really reduce the value or the valuations in your portfolio. You can find some opportunities out there if you look under the hood a little bit. So let's move on to bonds. And, I wanted to start off our bond discussion because right now bond yields are unattractive, and we all know that they're unattractive. But on that chart Bryan showed where we had the pullbacks from year to year, today is the 34th anniversary of the market crash in 1987. So Black Monday took place on October 19th, and it was the worst market day that anyone can remember, with stocks down over 20% on that day alone. And on a day like that, you wish you owned bonds. So bonds are great diversifiers. There's reasons to own them in every portfolio. And our view is, how do we capture the best value in the bond market? Bryan, let's talk a little bit about where yields have headed so far this year on this chart.
Sure. Okay. So if we look at this chart, what do we find from that peak in 1981 to today? We see a 40-year, literally a 40-year drop in real effective yields. One of the biggest reasons why, go way back to the inflation chart. We've had a 40-year, we had a drop, and then about a 30-year sort of stagnation in inflation. Okay. So when I'm looking at bonds, just to what Erich said before, I'm not looking to my bonds to outpace, my stocks. I'm not necessarily going for that. I'm looking at them to cushion volatility and create recurring income. Even today, even if it's not as much income as I want or I'd like to have, it is still doing that. Okay, so let's look at these two lines together, the blue and the gray. What is the difference between them? The nominal yield is the amount of recurring income per unit of price that I get from my bonds. Right now, using treasuries, it's not a lot. It's 1.5. All right. But what is inflation doing? It's creeping up. Well, that's not a great combination. That's why most people, at least that we deal with or I deal with, aren't 100% bonds, and they never have been. But you are going to have some. I have some myself. All right. So what am I looking at here? I want to know, what is my spending power? What is that? That's the difference between the yield that I'm creating and the amount of inflation. Historically, they have tracked rather closely. Lately, look at that red circle on the right. They have started to separate. The 10-year yield has crept up marginally to over 1.5 on this chart, but inflation is eating away at that spending power. Okay, but what do I still have my bonds for? That cushioning, that recurring income, that volatility mitigation is still hugely important, right? You're still going to get those days where you have big drops in stocks, because that happens. I need my bonds there, assuming I have some, as a cushioning tool and a way to kind of offset that volatility. They still do that. They absolutely still do that. Even if yields aren't that great, at least there's something, and they are still there for that purpose.
Yeah, so knowing that, bonds are really a core component of a lot of portfolios, and not an asset class that, most of us want to abandon, let's look for some opportunities in the bond world. And we've highlighted here on the far left of your screen, treasuries, and on the far right, mortgage-backed securities. Bryan, why are those two highlighted?
Okay, so the bond world, this is a really fascinating subject. For any of you who are still awake, keep in mind that the bond world has millions of components, right? There's all different kinds of issues. And so, but what tends to happen, if someone thinks of bonds and they really can think they know that world, they think of treasuries, because that's what you hear about a lot. That's what many people tend to own. If you don't really broaden out your holdings, you're going to end up with a lot of treasuries. But there are many, many, many other options out there, and they don't have to be high risk and they don't have to be high volatility. The two that we've highlighted here that Erich noted are the treasuries on the far left and mortgage-backed securities on the far right. Some of you that maybe are thinking back to 2008 might think mortgages and go, oh, that's that Alt-A stuff that was really risky. No. These are federally supported, backstopped, good mortgages. All right, well, what's the situation here? lots of numbers on the screen, but basically what I want to know is how much yield, how much income do I get per unit of risk, which in this case is mostly duration, length of time it takes to get paid out. Well, what has the single worst amount of yield per unit of volatility? Treasuries. They're awful for that, right? They're truly awful for that. Yes, they have full faith and support and all that other stuff, but I am taking those knowing I'm going to get this much interest. It'll take this long to get there. Think about this. Like if you really held a 30-year treasury to get 2% a year, all right. In the meanwhile, you could get a pretty okay, a good, well-rated corporate bond and get that in a sixth of the time. I think I'd rather do that. Okay, but let's compare it to mortgage backs. What's going on in mortgage backs? They are, like I said before, very safe. They are, many of them have federal backstopping. They're giving me 4 times the amount of effective yield per unit of volatility. I understand that trade-off pretty well, right? Am I not taking too much more risk? No. Am I getting 4 times the yield? Yes. All right. I like that. So in the world of bonds, what we really need to think about is what you don't want to own and what you don't want to over own. And so that's why we construct our bond mixes for our clients in the way that we do, is to try to just find reasonable, modest amounts of credit risk to get much more upside, relatively speaking. It's very possible. I know this chart's very busy, but that's what this tells me, is that's out there if you do the work, and that's, we're doing that. So we love it.
All right, and then finally, this is our last chart that we're going to show you all today, and we call it our Quilt Chart. You can quilt a portfolio together using all of these different asset classes. You can see on the bottom right, bonds are negative this year. That's highly unusual. Look at last year, bonds at 7.5%, and the year before that, bonds at 8.7%. So, we might have taken some of this year's returns last year and the year before and kind of accelerated it. But bonds as an asset class historically, it's very, very rare for them to be negative. On the other side, we have real estate at the top end of this spectrum. And, one thing as investors it's difficult to predict the future, but you can look for patterns in the past. And you can see some patterns on this chart, and those help to guide investment decisions and portfolio construction. So, this is part of the tools that we use when building client portfolios, looking at the historical returns of those asset classes and really bringing them together into a consolidated piece. Bryan, anything you want to add when looking at this chart? Nope. All right. Well, I think Bryan may be frozen again, but with that, I will move on to this final disclosure page. And I did want to say, Bryan and I have talked a lot, and our investment team has talked a lot about the tax impacts in Washington, D.C., as well as, the infrastructure bill that is currently in discussions in Washington, D.C. When details of either of those become available and it's a little more clear of what we might be faced with as investors, we're looking to conduct a webinar really to walk through those points and to discuss those specifically. But again, if anyone has any questions about anything we've talked about today, please feel free to reach out to your advisor, to myself or to Bryan. We're all happy at Cutler to discuss how any of this might impact your portfolio. And I just want to thank you all for joining us today. Sorry about those technical glitches that we had along the way, but thank you for making it this far. And again, thank you for your trust in Cutler. Have a wonderful day.